Hey guys, welcome to another episode of the Real CFO Project. Hey, my name is Chad Brown, and today we're going to talk a lot about the One Big Beautiful Bill and some of the tax changes that were in there that you can take advantage of. It's the end of the year. Everybody's kind of scrambling, holidays, Christmas, all that stuff. So we wanted to drop this now so you could still have a couple of weeks to take some action on some of these tax savings. So a little bit of information on the One Big Beautiful Bill. It passed back in June. There's been some rules and stuff that have been released regarding some of the tax positions and things that were involved in it. So we're just going to go through high level, and this is going to impact you on a business level as well as an individual level. So hope this helps. That's the goal here. As always, when we're discussing something, is to bring value to you, the listeners. So if you know anybody that might be interested in hearing this, please do share. So let's just dive in real quickly. So just kind of went over the One Big Beautiful Bill. Is major tax legislation in 2025. It's impacted both businesses and families. It expanded some deductions and credits and restored others. Also kind of eliminated some, didn't touch them, didn't expand them, so they were allowed to sunset. So it creates really some year-end action items that you can take, as well as some retroactive opportunities that are amazing for small businesses. So that's a big deal. So, but it requires some proactive planning, and not just compliance pieces. You have to have your ducks in a row. You have to have documentation, all of this information sorted out. So, why the bill really matters? Well, it creates immediate savings opportunities. Anytime there's change, new credits, new deductions, gives us an opportunity to kind of look at things, say, hey, where are we at and what can we take advantage of? It allows us to go back into some prior years as well and make some corrections. And doing so, it kind of unlocks our cash flow through maybe filing amended returns, getting credits that have been expanded or changed a little bit. That now we can go back into 22 and 23 and get those credits, and it'll create immediate cash flow. Give you an example. We've got a client that we started doing some tax credit work for with a partner of ours, and they generated close to six figures in tax credits. And then when this bill passed, we're now able to go back, and they're going to get another high five-figure tax credit for both 22 and 23, which is a huge deal, right? Imagine that you get another, probably, I'd say between the 2 years, you're probably looking at 150 in tax credits, 160, 75 to $80,000 for partners each. That's real money. That's a game changer. That's college education. So if you're on the fence about some of these things that you might qualify for, hey, it never hurts to ask. My grandpa always said the only dumb question was the one not asked. So I don't know if I completely agree with that 100%, but 99% of the time it is true. So what happened? What are some of the changes? Okay, so you got 100% bonus depreciation was reinstated. It was set to be, I believe, at 40% this year, right? You buy a $100,000 piece of equipment in your business, you can deduct 40%. That's $40,000 deduction. 3% tax or 30% tax bracket might save you $12,000. Now it's 100. Okay, 30% tax bracket saves you 30. Take that 30 and go buy another piece of equipment. See how it helps the economy, helps your business grow and expand if you utilize these strategies the right way. So 100% bonus depreciation is a big deal. It also expanded the 179 expensing limits. I believe it rose it up to like 2.5 million, if I'm not mistaken. Don't quote me on that, but it went from like 1.2 to 2.2. This applies to, business vehicles, equipment, also technology purchases, software you buy in your company, big build outs of your CRM, things of that nature. So it's a great time to look at those. I'm not saying go out and buy a vehicle because you need a tax deduction, but you don't need a damn vehicle. That's a waste of money to buy a depreciating asset you don't need to save on taxes for a short period of time. When, a lot of people that actually do this, their business isn't as profitable as they think because they don't track things. Kind of a side note, they don't track everything, so they don't know how profitable but their business is. So they're buying a $90,000-$100,000 truck. They don't need it to save on taxes. Why? Because their business had carryover losses from prior year, or their business might be losing money, or they might made an investment into some other equipment that offset that. So don't be the one that goes out there and uses that. I need to buy a truck to save $100,000 truck to save $20,000 in taxes, or defer $20,000 in taxes just for the sake of doing it. Kind of a bullshit thing to do, especially for your business when you're taking care of, other families, your family, right? You have employees. Think of that. Don't just think of that big, nice, shiny truck if you don't need it. Um, all right, here's a big one that's been talked about here a lot is the Trump accounts, right? Trump accounts are for children born between 25 and 2029. So what it does is children born in between that time will get $1,000 placed into their Trump account. Now, the setup is there's a form that you have to file with the filing of the 2025 tax return. Once you do that, it'll set up the account. And then I believe the funding and all of that will start in June or July, right? So were you born outside of those times? You can still set up a Trump account. I'm not sure if it makes sense, but you can do that. So there are employer matching and benefit plan opportunities around this. So if you want to match the employees, you can. It's a big benefit. It can be a deduction for the business. Now, it can't discriminate, right? So if you're a business owner and you want to just contribute to your kids' account, as a tax savings or do something in that regard, that is prohibited. Just like any benefit, health benefit plan or retirement plan, it can be non-discriminatory. So more rules are rolling out on that, but it might be a great incentive that you can provide your employees. Okay. Um, Right. Meals, entertainment, and employee incentives is another area that changed. It's kind of give us a partial restoration of entertainment deductions, meaning ball games, golf clubs, things like that, client events, employee appreciation planning. So make sure when you're looking at your meals and entertainment, before it was kind of non-deductible if it wasn't business related. So entertainment was a big one. Expanded Section 128 education and training deductions gives you an opportunity to get more deductions for paid training for your employees and such. Immediate deduction for workforce development costs. So those were some of the big changes. Now, energy and sustainability incentives, the energy efficiency deductions are probably going away. But one of the big things that we can still do is you can look back at the expanded energy efficiency deductions, look back, Section 179D improvements for buildings, and retroactive eligibility and claim retroactive eligibility. Now, 179D is a big one for contractors, architects, engineers, that sort of thing. And a lot of people don't know about this, or if they do, they're sitting on their laurels and not going and chasing it. But there's a huge opportunity as it relates to contractors, engineers, architects that have worked with nonprofit and governmental units. There's deductions out there available for these energy efficient improvements to buildings. I think it's up to $5 a square foot. And if you know anything about nonprofits and governments, they can't claim those credits, right? Or those deductions. So they can allow for contractors to get it, but they have to be released to the contractor, signed off on by the nonprofit, attesting that they did the work and passing those along. So it's something that you need to look at. Architect firms are generally aware of it, and they might be trying to take all of it for themselves. So if that's you, it might be worth a phone call with me. Got some partners that really dive in and help you see if you qualify and if you can go get it. But it's something that you need to look at. Now, going forward, any projects put in service or in operation to build out after, I believe it's June or July, are going to not qualify to my knowledge. So, and there are some transferable these credits are transferable, like I just said, for nonprofits and governments. So if you work with some of those, it might be a great opportunity for you to do that. Um, Here's some retroactive opportunities. If you, excuse me, had some reduced bonus depreciation in the past, you can go back and correct that. You may have to file a form 3115 to change that accounting method. Excuse me. But it's something to ask your CPA or accountant. But there are things you can go back and correct that bonus depreciation. And if you were to do a refund, it might be a cash refund, increase your cash flow. Um, they reinstituted or restored, I should say, the immediate expensing of research and development expenses. So in the past, companies were required, if they had R&D expenses, they had to capitalize them on their balance sheet, meaning they were able to depreciate an expense over a period of years. Now that has been restored to immediate expenses. And here's the beautiful thing. It went back to 22 through 24. So what folks can do, they can go back and amend their 2022, 2023, 2024 return. If they haven't filed that with the corrected rules, a lot of people did because it was extended. You can go back and correct those years and expense those right away, as well as qualify for the credit. So that is a big deal. Qualified small business stock and capital gain planning, that is a big one. It's coming more and more to light. It's been around for a little bit, but the one big beautiful bill clarified parts of Section 1202 and the rules regarding the deferral or the complete elimination of capital gains on qualified small business stock. So it kind of changed the rules in terms of amounts that would qualify. Section 1045 rollover opportunities, where if you fell short of that 5-year window, you might be able to roll that. If you sold that stock short of your 5-year window to qualify for the capital gain exclusion, you could roll that within 60 days into another qualified small business stock and carry on that and then get to your 4 years. So that's a big deal. Again, this fixes the disrupted holding periods, and it's a big high impact planning for exits and investors, and something that we're really looking at for existing business or new businesses now. So there's some other changes, but those are the big ones I wanted to highlight on. If you have any questions, feel free to reach out to us. We'd be more than happy to help you navigate some of these. I'm in a different office shooting. I got the sun coming up behind me, as you can see, but just wanted to put some of these out there to get you mind thinking here in the next few days. Is there something that we can do now in 2025 to save money, but also what are we looking at towards for 2026? What decisions do we need to make? And I think this might help you out a little bit. Again, this is helping you be intentional about your financial discussions around your business and how that impacts your family and everything. So that's what we want to try to do here. If you have any questions, reach out to us. We'll talk to you guys next time.